Hi, and welcome to the next episode of Common Law in Simple Flow. In this video, we're continuing our topic corporation tax, and this is our second part. So, in the first part, we have discussed the first two steps of the calculation. We have discussed what is the corporation tax, and now we will continue our steps of the calculation and we will start with this video with step 2. So in the second step, we are implying the exceptions and reliefs. So we have already applied, so to say, the capital allowance. And now let's see what is a trading loss relief. A trading loss happens when for a period your tax adjusted trading expenses and reliefs exceed your trading income after add backs and capital allowances. So, in short, your business spent more than it earned from trading that period. So, once again, trading loss happens when for a period when you have adjusted your adjusted trading expenses and reliefs exceed your trading income. So trading loss relief is how the rules let you use that red number to cut your tax by setting it against profits now or later. So let's understand what does it mean use it now in the same year and use it what's left later, so to carry forward, and must use rule. So as we said here, so the trading loss relief is how the rules let you use that red number to cut your tax by setting it against profit now or later. So when you want to use it now at the same year, if you have a trading loss, this accounting period first offset it against any other profits or gains in the same period. So property, profits, interests, or capital gains. This can reduce this year's tax bill to zero. So here we have an example. I think we have an example for all of them. So let's discuss the second and the third, and we will go to the example. So let's see then a simple example. It's not here written here. So your business earns, for example, 10,000 pounds. Your business spends 30,000 pounds on allowable costs. So it is rent, supplies, travel, and so on. That means the result, the trading loss is 3,000. So you lost 3,000 that year. For tax, that 3,000 can usually be used to reduce the tax. So if some loss, so use what's left later, so carry forward. If some loss is still unused, you can carry it forward and set it against future profits under current rules, generally against total profits. So how it is in a real life. So for example, you are in year 1, your business makes a 5,000 loss. You have no other income to offset it against, so loss is unused. In the second year, your business makes 8,000 profits. So it's not in that year you have done your 5,000, but in the next year. So you use the old 5,000 loss you have done in the first year, and the taxable profit would be 8,000 of this year, your profit, minus 5,000 from the last year, and it would be 3,000. You only pay the tax on your 3,000, not 8,000, because you had this 5,000 loss, which you have carried forward to this year. And let's see the must use rule. When you next have profits, you apply the brought forward loss straight away. If any loss remains, keep using it in the next profit year, and so on until it's gone. So that means every time you make a profit, old losses wipe it out first until they gone. Let's see an example. This is here. This year, trading loss 40,000. Other profits, interest plus gain is 50,000. So you use 50,000 of the loss now to wipe out this year's profits. Tax becomes £0. The remained 25,000 loss remains to the 25,000 which has been remade, you carry forward to the next year. So next year your profit is 30,000. You use the 25,000 which you brought forward in your loss, and your taxable profit would be 5,000 because you minus from 25,000 to 30,000 your profit, and at the end you only your taxable profit is 5,000. So carry forward losses don't expire. You can use them in future years. But there is an annual cap on how much you can use once your profitable gain. Oh, this is important. So there is a cap how much you can use. Oh, it's a little bit big. Make it smaller. And yes. So let's see. You can always offset up to 5 million of profits in full each year, the deductions allowance. Above that, you can offset only 50% of the remaining profits with carried forward losses. So let's see an example to understand it better. Let's say that this year your profit is 12 million. Carried forward losses available 20 million. How much loss can you use this year? The first thought would be that you can cover 12 million profit with 12 million losses, which you carried forward. But you can only use 5 million from your carried forward losses we have talked about here. The rule is that you can always offset up to 5 million of profits in a full each year. So if you cover with 5 million losses your 12 million profit, there will still be profit left, namely 7 million. So of the remaining 7 million, you can cover 50% with losses, 3.5 million. So here we can see very good in the example the rule. First of all, you remember that you can always offset up to 5 million profits for full year, each year. Above that, you offset only 50% of your remaining profits carried with forward losses. So our first step, we're checking that how much profit we have done this year. This is 12 million, sorry. And here we can minus from our carried forward losses from this 20 million, only 5,000. So that means we have our 12,000 minus 5,000. We have now 7,000. And the remaining 7,000 we can cover with 50% losses, and it would be 3.5 million. So important is that 5 million allowance is shared across the group if you are in a one. So So with the group, I mean the company goods, so parent and its subsidiaries. So let's go back. You can use past trading losses in later years if same trade was carried on in the loss year and in the year you claim the loss. And in the loss year, the trade didn't shrink to being small or negligible. For example, effectively dormant ceased. So these are two important requirements for the trading losses to be taken forward to the next years. The first one, the same trade, it's the same business. You must still be doing the same trade, same type of activity, same business ideas, not something completely different. So that means you can't use losses. This is again something is not written in the flow. I'm just giving a short example before we have the bigger one. And you can't use losses for a cafe, for example, to reduce profits from starting a construction company. And the second point was what I've mentioned is the business didn't basically stop. So that means I have mentioned here small or negligible. So in the loss year, the business must not have become small or negligible, meaning it didn't effectively shut down or it wasn't dormant or barely operating. So if the business almost stopped and later restarted, an Asia Mares may say the losses can be used. So the trading losses are tied to a specific trade, as I've mentioned. If that trade stops or is basically inactive, those losses can be rolled into the different or new trade. Let's see an example. So it continues when this is the case. So you run a coffee shop, make a loss in 2024 and keep trading normally in 2025. So profits in 2025 you can use for the loss for 2024. Small negligible. In 2024, you serve one customer a month and you were closed most of the year. Trade is effectively dormant. HMRC can treat the trade as ceased. So in 2024 loss generally can't be carried forward. It can't be carried forward. New trade. You stop the coffee shop in 2024 and start a web design business in 2025. Coffee shop losses can't be sent against web design profits. That's a different trade. And the last one, a major pivot, new trade. You stop selling coffee and convert into the nightclub with a total different activities. Losses from the coffee trade typically don't carry over. So let's see what does it mean carry back. So this is the it's a little bit long. This is sounds like a vice versa for what we were talking about. So if you make a trading loss this year, you can, after using it in the same year first, carry it back to reduce tax you're paid on any profits, trading or not. For example, gain interests, dividends made in a 12 months immediately before the start of the loss period financial year, which had the loss. So let's see an example and we will discuss the conditions separately. So EY profit 60,000. The tax would be 20%, so 12,000. E2 profits 10,000. This is year, I'm sorry. So in a first year, you profit 60,000. The tax is 20%, so 12,000. In year 2, your profit is 10,000. In year 3, the trading loss 25,000, carry back 12 months wipe. Year 2 is 10,000. This 10,000 would be 0. Then 50,000 from this 25,000 loss remains to carry forward. Year 1 is untouched outside the 12-month window. So total corporate tax over the 3 years is then 12,000, the year 1 tax. So once again, before we discuss the conditions to this rule, short. So if a business make loss this year, you can use this year first. You are using this year, and then you can carry it back, but only 12 months, only this 12 months, to reduce last year's profits and get tax back. You can't go further than 12 months. So the condition 1, you must first use inside the loss year against all profits, gains of that same year. Only the leftover can be carried back. And then condition 2, the trade not necessarily in the same is still being carried on for profit. So let's see an example. Or maybe we can go here. So short, let's go here. The look back window is the exact 12 months before the loss period starts. Even your previous accounting period was shorter or longer. So it should be always 12 months, not more, not less. So example, company year, 1st January 2025 and till 31st December 2025. The 2025 results, the trading loss is 120K, also a small chargeable gain 20K in 2025. So in the same year, set off first use 20K of the loss to wipe out the 2025's gain. 100K loss remains because we had 120. Then as a next step, we carry back, we look at the 12 months before 1st January 2025. This is 1st January till 31st January 2024. Suppose in 2024, we had profits from all sources, 80K. You can carry back 80K of the remaining loss to eliminate those 2024 profits. So, your 20K loss still unused can be carried forward to future years subject to normal rules. So, what has happened in this example? You have a loss 100,000K, and in the same year you have gained 20K. So you use this 20K for the trade loss. So you are minusing from 120K 20K. So you have at the end 100K. What you can do as a next step, you go back 12 months to check how much profit you have done in 2024. You see that it's 80K. So what you do, you take this 80K and take your 100K, the loss for this year, the remained loss, and you minus it. And at the end, you would have 20,000. So this 20K loss still is unused, and this can be now carried forward to the future years. So let's go back shortly, and we have here 2 examples. So two different rules of trade losses. The first one, same period and 12-month carryback of the loss. So the requirement is you are carrying on a trade in a loss period and not wholly outside the UK. No need for it to be the same trade as the earlier profit period. You can set the loss again, total profits of the loss year end or the previous 12 months. The second rule, carry forward of loss to later years. Continuity of trade required. The same trade must continue from the loss period into the years and use the loss. It must not become small or negligible in the loss period. Losses arising on after 1st April 2017 can usually be set against the total profits in later years, subject to 5 million plus 50% cap. But that same trade continuity still matters. Pre-2070 carried forward trading losses generally remain restricted to profits of the same trade. So here, what two differences we have talked about? We have two different rules. The first one, the same year and the 12 carryback of the loss. This has easy rules. So when does it apply? You make a loss this year, you want to use it this year or last year. So here what's required, you were running a business in the loss year. It doesn't not have to be the same trade as before. So what you can offset against the total profit, trading profits, capital gains, insert dividends and so on. The second rule is carry forward the loss to later years. So here requirements are a little bit strict and what you need, what are the requirements? It should be same trade and the trade must continue. Business must not stop or become tiny. A trade must still be real and active. What you can offset again, this is usually total profit. This is on and after 1st April 2017 losses, but this is still subject to limitations 5 million, what we have talked, and we have talked here. So 5 million and the 50% cap. And the comparison would be that for the same year, it's not written here, but let us shortly just see the difference. When you are using clauses in the same year, it should not be the same trade because you're doing in the same year and it's from your total profits. You can use losses from 12 months back. It's no same trade and a total profit, and future years it's the same trade needed and the profit are with limitations. So what's important here to see the difference carry back and the carry forward. So in the carry back, no same trade test, so there is no need of the same trade test. But for carry forward, the same trade is needed. So let's see here, 2023, 2024, loss from care services, 80,000 are carried back to 12 months to 2022-23 profits from manufacturing, and 60K. There is a 60K, so wipe 60K is okay. And for the carry forward, the same trade is needed because you are forwarding it to the next year. So that's why it's important that you are doing the same trade. So 23-24 loss from manufacturing 120K. 24-25 you are stopped manufacturing and only do care services. So this is not the same trade. You can't use that brought forward manufacturing loss unless the manufacturing trade continues and it is not a small and negligible. So this is important to remember these differences. So we have discussed this and carryback timeline. Let's see now carryback timeline. So the carryback works most recent first. You start with the accounting period immediately before the loss period and then move backwards. So your carryback works most recent first. So the claim only covers the 12 months immediately before the start of the loss accounting period. That can, however, happen that a preceding period is short, for example, 6 months, and previous 12 months consist of 2 accounting periods, each of 6 months. So 12 months consists of 12 accounting periods in each of 6 months. And if you have limited amount of losses and you won't be able to cover both previous account periods, you cover closest accounting period to your current period, namely exactly the previous one. If anything remains, you move the older period of 6 months, which is timely more distant to your current year. So if the descending period is long, for example, at 80 months, you can only relieve the last 12 months of it. No timeline needed here. So important note here is that a company financial statements can cover more than 12 months, for example, first set of accounts for 50 or 80 months, but a corporation tax, HMRC tax accounting period, CTAP cannot exceed 12 months. So if your account span longer than a year, you are forced to split that long period into 2 corporation tax periods and file 2 corporation tax returns. So for the HMRC, the tax accounting period cannot be more than 12 months. Let's see an example. Example, accounts from 1st January 2024 to 31st March 2025. This is a 50 months. Corporation tax is split into 2. The first one would be the first 12 months, and the cap 2 would be the 3 months. So from this 15 months, you apportion profit reliefs between the 2 CTAPs and submit 2 returns. So you are submitting 2 returns in the case when the company's financial statements cover more than 12 months. So for each period you do claim against, you must wipe its profit to 0, no partial relief for that period. You can choose to only knock off part of a period's profit, but you profit if you have enough loss to wipe it out. If you don't have enough loss to cover the full accounting period, you use your full loss on it regardless whether you cover it or not. So that means when you use a loss against a year, you must use it to cancel that year's loss completely, year's profit completely. You can choose to only cancel part of the year's profit if you have enough loss. So if your loss is smaller than the profit, so you use all of the loss even though the profit isn't fully wiped out. So tiny example, profit in year A is 10K, loss available is 6K. Use all 6K for that year, so the profit left would be 4K. So that means you can say I'll only use 3K from your loss available, which was 6K. So, and the last part of the subflow is the short accounting year. As shown in a previous examples, the accounting period of companies could be sometimes shorter, and you need to be more attentive to the actual periods and calculate the correct tax only for that period. So let's see examples. Calculate for year 2024-25. So your accounting period is from July to June. So July 24, June 2025. Altogether 274 days in financial year 24-25. Receipts 1,800,000. Expenses 220,000. Gain 40,000. A year profit would be 1,620,000. The financial year 24-25 share would be this year profit 1,620,000 multiplied by 274 the days divided 365 days, and it would be approximately 1,260,000 and 110. So we're calculating for, so as you can see, it was not the whole year, it was shorter the year, and we were multiplying it with the days of your accounting period, and we're dividing it with the 365 days in a year. So with this way, we're calculating the trading gross relief. So same with the others. So you're calculating in the same way. You see your receipts, expenses, the gain, and year profit, and you take your year profit and multiply with days of your accounting period and divided it with the years. So that was all about the very long subflow, which was about the trading loss relief. As next, it's coming to terminal loss relief, and here we have for the both. So something important to mention: you can only use company trading loss relief if the trade's profits would be taxed in the UK. So the trade is within the UK corporate tax charge. If a company is UK registered, but its entire trade happening outside the United Kingdom, so those profits wouldn't be taxable here. So these profits would not be taxable here. Then the UK loss relief isn't available for those trading losses. So UK loss relief would not be available for this trading losses. This is important to remember. So let's see the terminal loss relief. If your company stops trading for good, the losses from the final 12 months of trading, the terminal loss can be carried back up to 3 years to get tax repaid. So if you are completely shutting down your company, you can go back with the final losses back to 3 years. So you must set it against the most recent year first, then move backwards within that 3 years window. So the final 12 months is a rolling 12-month period, not necessarily the same as your last accounting period. So it's not necessarily same as your accounting year period, because which could be shorter. Let's see an example. So example 1, a simple date, straightforward profit. So trades, this is 30 December 2026. Terminal loss period, final 12 months, October 2025, 30th September. Loss is 180,000. Carryback window for profits, the 36 months before the 1st October, our 1st October. So year A, from 1st October to 30 September, profit 40,000. Year B, 1st October, 30th October, 23-24, the profit 90,000. Year C, we're in 2022-2023, the profit is 120,000. Relief most recent first. So we set against year A, we take the 1, so 40,000, the loss left would be 140, so we're minusing it from taking out from 180,000. Then for the year B, we have 90,000. So the loss relief would be 50,000 from 140 minus 90,000. And now we have the year C, where we had 120,000. And the year C up to 50,000, so loss left is 0. So that was all about the terminal loss relief. So now let's see what is the next in our step 2. So early years loss relief for individuals, not the companies. So early years loss is only for the individuals. So this is a special relief for sole traders and partnerships and incorporated businesses in the first 4 years of trading. So in the first 4 years of trading, this is important information to remember. This is for first 4 years of trading. They can carry back those early trading losses and set them against their other personal income from the previous 3 tax years, using the earliest year first to generate tax repayments. So as I said in the beginning, the companies cannot use this. This is only for the individuals. So the sole trader starts in 2025-26 and makes a 20K loss. They can carry it back against their employment, rental income from 22-23, 23-24, and 24-25, earliest first, until the 20K is used, potentially triggering refunds. So that's all about the early years losses relief, which is only for individuals but not companies. So the next one is coming, the capital losses relief. Let's have a look how many still we have. A lot. So the capital loss relief. Think of 2 sources of income for the company: A, the trading profits, and B, the capital gains. A capital loss belongs only in B source, the capital gain. And the capital loss is you sold an asset for the less than what it cost for tax. So we have talked in one of our already topics about the capital gains, and this is in the capital loss relief is only for the capital gains, not the trading profits. And the capital loss is when you have your asset and you sold your asset with less money that is usually costs. And and that's the capital loss. So you can only use a capital loss to reduce a capital gains. So you cannot use it to reduce trading profit, interest, rent only for capital gains. So let's see an example. You bought a machine, a chargeable asset for 100K plus 2K legal fees. Tax base is 102,000. You sold it for 90,000. A capital loss would be 12,000. So you bought with 100,000, you sold it with 90,000. You have loss of 12,000. So how it's used? Same period first. So set the capital loss against chargeable gains of the same accounting period. So you are doing it for the same accounting period. First, carry forward if unused. Any leftover loss is carried forward indefinitely, but still only against future chargeable gains. So here we don't have a carryback. So we have for the first year, for the same period, we have the carry forward if unused, but we can't do a carryback. You cannot carry capital losses back to earlier years. So annual cap when using carry forward, there is an annual cap for it. So in any later year, the amount of carried forward losses you can use is capped at 5 million plus 50% of the remaining gains after 5 million slice. This is the same as we have discussed. So the 5 million deduction allowance is shared across a group. So we have talked about it already here with the trading loss relief. And this is the same for here. So for the capital loss relief, what we need to remember, we need to fix that the capital loss is only for capital gains, only gains, not a trading profit, not a capital profit. What's important that each could be done in the same year period. First, it could be carried forward if unused relief, but it could not carry back. It's important. Let's add a star. And we have also here annual cap 5 million plus 50% for remaining gain after the 5 million slice. So that was a capital loss relief. Now let's see rollover relief. What it does. If you sell a business asset, for example, land, building used in the trade, plant and machinery, and buy another business asset, you can usually postpone the capital gain. Interesting. So you can postpone to defer your capital gain. So how it works? Instead of paying tax now you subtract the gain from the sale of your old asset from the cost of the new asset. So if you had 100,000 gain from selling your machinery and you buy something similar for 400,000, the starting base price for tax would be 400,000 minus 100,000. That lowers the new asset's tax base, so more gain will be crystallized when you sell the new asset later. When you sell it later for 450,000, instead of 50,000, your gain will be 150,000. So what does it mean? So with this, you are just delaying, you are not avoiding your tax, you are just delaying it. How? Instead paying now. So what do? You gain 100,000, you sell your old machine, you gain 100,000 for it. You're not paying tax now. You buy a new machine and you buy the machine with 400K, and for tax it cost 300,000 because you have this 100k gain. So you minus for 400k 100k, so now you have 300k for tax. That lowers the new asset. So then you decide to sell your machine, which was 400k, with 450k. So you minus from this 450k the 300, and your gain then would be 150k. So this 150k includes also this 100k gain from last time. So let's see conditions so it would be easier to understand. Condition 1, you are trading when you sell the old asset and when you buy the new one, and both assets are used in the trade. So the condition 2, timing window, buy the new asset from first year before up to 3 years after selling the old one. And the third condition, claim deadline, the relief must be claimed within 4 years of the end of the tax year containing the later of the two events, sale or purchase. So partial reimbursement, part tax now. So sell old permits for 500k, gain 120k. Reinvert 440, you kept 60k cash. Immediate charge will be the cash kept 60k, can be taxed now. Deferred gain would be 120 minus 60, so it would be 60k. Reduce new assets based by 60k minus 380k. So in this example, you have taxed the part now, so your cash 60,000, and the rest has been left for the upcoming year or years. So that was all about the rollover relief. And let's see the incorporation relief, what it is. So imagine you have a business as a person, sole trader partnership. You decide to transfer the whole business into the new company. In return, you don't take cash, you take shares in the company. So what happens to tax on your build-up gains? So for example, goodwill, property that went up in a value when transferring them to the new company. So normally you'd pay CGT now when you transfer those assets. With incorporation relief, you don't pay now. The gain is parked, deferred inside the cost of your shares. So this is parked inside the cost of your shares. This is, I won't pay today, add that gain to the shares, so I'll pay later when I sell the shares. Okay, so it's parked, it's added to your shares, and you will pay your CGT later when you sell those shares. So who qualifies for this? So you are a sole trader or partners in a partnership, not already a company. and you transfer all business assets except cash to a company, all your business and assets. So you receive shares as the consideration, wholly or mainly shares. So the cash part up to the gain is taxed now. The rest of the gain is deferred into shares. So the cash part is taxed now, but the rest, with the rest we so let's see an example. So business market value transferred 300K. Total asset tax base is 100,000K and the gain is 120K. Company issues 300,000 of shares, no cash. Then 120K gain deferred. Your share base costs 300,000K minus 120K. Okay, this is your gain. So 100. So okay, so 180K is your total assets. So you pay CGT when you sell the shares. So this is 180 your share. And when you sell your shares using at their cost, one moment. Okay, let's discuss once again this example. So you bought your business, so you have invested it, for example, with 180K. So you decide to sell your business and you are selling your business with 300,000, and normally it would be 120K gain. So instead of the cash, the company gives you shares. So they are not paying you this 300,000, but the company is issuing you shares, and you can't then pay this gain, 120K. What's happening? These gains are parked within your shares, and your share base cost would be then 300K minus 120K, your gain. So this 180 is the cost of the shares for tax purposes. So here you don't pay for CGT when you get the shares. You don't pay CGT while you hold them, your shares. You pay CGT when you just sell your shares. So that was all about the incorporation relief. Let's talk about the group relief. What is a group relief? So we have mentioned it sometimes at the top, at the beginning. So group relief lets companies in the same group share losses. So if a company B makes a current year trading loss, it can give surrender that loss to company A, which has profits. Company A then reduces its taxable profit by the amount and pays less corporation tax. So, company B makes a current year trading loss. So, let's make trading loss. It can give that loss to company A. So, that's giving to the company A loss, which has profits. Company A then reduces its taxable profit by amount and pays less a corporation tax. So A has profit 200K, B has lost 150K. 50K. A uses B's 100K. A is taxed on 50K. So who counts as same group? The 75% test. You are in a 75% group if either a parent owns 70% or more of a subsidiary, or two sister companies are each 75% plus owned by the same parent. So, the requirements. A parent owns 75% or more of subsidiary, or two sister companies are each 75% plus owned by the same parent. So a sister A and sister B are each 75 plus owned by the same parent. They are in the same 75% group. Sister B loss maker can surrender its current year trading loss and certain other current year deficits to sister A, profit maker. Then sister A reduces its taxable profits by that amount. What losses can be shared? This year's trading loss, the big one, this year's interest, back interest on not trading loans, this year's UK property loss, rents that you received is lower than property expenses like repairs, agents, fees, insurance, and management expenses for investment companies. So again, what losses can be shared? The first one, this year's trading loss, this year's interest, this year's UK property loss, management expenses. So what can be not included? The capital losses. They use separate group capital gains rules, note group relief. This is separate group. So once again, the trading loss, this year's interest, this year's UK property loss, the property loss, management expenses, and what is not, the wrong one, and what is not included then is the capital losses. The capital losses could not be shared, but the property loss, yes. So let's highlight it and see what's coming next. How much can the profit company use? The claim is capped at the lower of the loss available to surrender and the claimant's taxable profit before group relief. So you can't turn the receiving party into the loss using a group relief. So example, A Ltd profit company has 100K taxable profit. B Ltd, a group company, has 150K surrenderable loss. A Ltd can only claim 100K via group relief, the lower of A's profit and B's loss. A's taxable profit becomes zero, it cannot go negative. So the remaining 50K loss stays with B. So to carry forward or use otherwise. So you can't turn receiving party, the other, your profit company, in your group company into loss using group relief. So you can't do this. So let's highlight it once again. So timing and paperwork, same year overlap, easiest if both companies have the same year end. If not, you only share the part that overlaps the time. So you only share what overlaps the time. Then, who files? The profit company claimant is the company that is in plus and will receive the loss. Claims on its return. The loss company must give return consent. The loss company should give a written consent. Deadline usually 2 years after the end of the claimant's period, and anti-avoidance, if there are deals that would change who controls the group when the loss arises, relief can be blocked. So relief can be blocked if the deals that would be changed who controls the group when the loss arises. So this is again an important information, the timing and paperwork. So if they have a same year, so easiest when the two companies have a same year end. If not, so the share would be for the overlap time. Who files the profit company claims on its return. So the last company must just give a written consent. The deadline is 2 years after the end of the claimant's period. And there is also one point when if there are deals that would change control of the group when the loss arises, the relief can be blocked. So that was all about the group relief. And now we're talking about the diverted profits tax. So, what is diverted profit tax? A UK charge aimed at a large multinationals that make money from the UK customers but try to avoid UK corporation tax, for example, by saying they have no UK permanent establishment or by using contrived pricing structures with group companies. So who it hits? Generally big groups, think 10 million plus UK related revenues using those kinds of arrangements. Diverted profit tax. So let's talk about the rates. The rate DPT, diverted profits tax, is 31%, raised from 25% for periods from the 1st April 2023. So this is higher than normal corporation tax because it's 25%. Why it exists? To stop profits being diverted out of the UK and to punish groups to fix their transfer pricing P position instead of paying DPT. So if a non-UK company sells 50 million to UK customers via structure claiming no UK PE and HMRC believes profits really belongs in UK, HMRC can assess DPT on those diverted profits at 31% unless the company amends its CT corporate taxation position to bring those profits into the UK corporation tax instead. So that was all about the second step. It was really a huge step. So we were talking here about exemptions and reliefs. So we're calculating all of them, so seeing how the calculation functions. And now we can go to the last two steps. The step 3, utilize losses by type. We would have also a substep for the step 3, deduct qualifying charitable donations, and the last one, the fourth, the calculation of corporation tax. So step 3, utilize losses by type. So use losses according to their specific rules, trading, capital, and so on. The capital losses can only offset capital gains, never trading and corporate income profits. Trading, this means if you did not have a capital gain but you had a capital loss, you cannot deduct your capital loss from trading profits. You never can do this. So this is an important information, so let us highlight it. And remember that if you did not have a capital gain, but you had a capital loss, you cannot deduct your capital loss from trading profits. You can deduct capital loss only from capital gain. So capital loss cannot reduce trading profit. The trading profit is 200K, capital loss is 60K, capital gain is 0. Result, you still pay corporate taxation on 200K. The 60,000 capital loss carries forward to use only against future capital gains. So neither companies nor individuals can carry back capital losses to earlier year to offset past gains. Neither companies nor individuals can carry back capital losses to early years to offset past gains. So, capital losses must first be set against capital gains of the same tax year. First, be set of tax against capital gains of the same tax year. Any excess is then carried forward identifiably to offset future gains. There is no carryback. There is no carryback. So, that was important. Once again, neither companies nor individuals can carry back capital losses to earlier years to offset past gains. So capital losses must first set against the capital gains of the same tax year, and any excesses then carried forward identifiably to offset future gains. There is no carryback. So, about the trading clauses, can offset total profits of the same period, including gains, carry back 12 months, also against total profits of that prior period, carry forward under current rules, generally against total profits, subject to 5 million plus 50% cap. So, trading clause offset profit gains is the same in the same year. Trading loss 120K, interest income 40K, capital gain 50K. Use the trading loss against total profits this year. First, 40K plus 50K, it's 90K. Wipe this 30K loss is left to carry forward. Carry forward trading loss showing carry forward trading loss showing the rule difference. Prior year trading loss is 300K carried forward. Current year trading profit 100K, capital gain 50K. Current low use current forward trading loss against total profits. It's cover 100K and it would be zero taxable, cap not relevant at these levels. Various scenarios assumptions, older, stricter. The trading clause only against trading profits. Wipe would be 100K. You still pay corporate taxation on the 50,000 gain. Before April 2070, a carry forward trading loss could be used only against future profits of the same trade. It could cover, so I let it. It couldn't cover interest, property income, or chargeable gains. From 1st April 2027, loss reform, most carry forward losses arising on or after 1st April 2017 can be set against the company's total profits, including gains, subject to 5 million deduction allowance per group and 50% cap above that level. So this is an important information. So many scenarios still assume the pre-2070 rule for simplicity, so they don't let carried forward trading clauses shelter capital gains. In real life, for 2024-25, if the laws arose on after 1st April 2017, you generally can offset it against gain with the caps. So losses arising before 1st April 2017 generally retain the old restriction. Same trade only even if used in a later years. So even if used in a later years. So this is an important information. So that was all about the utility losses. We have an extra step, deduct qualifying charitable donations. This gives taxable total profits, TTP, and charitable donations, qualifying charitable donations, for example, gift aids to UK charities, are deductible in computing taxable total profits. They are taken after losses. And last step in our very big and long flow is the step 4, calculate corporation tax. So the result is taxable total profit. Apply the CT, corporation tax rates, to get the corporation tax due. If you receive, for example, after all calculations, you end up with the taxable total profits, the TTP. The number is what the company is actually taxed on. So what do you do next? You take taxable total profits, you apply the corporation tax rates. So usually, for example, 90%, 25%, depending on the size of the company. And the result would be corporation tax you must pay. So if you receive, for example, R&D research and development tax credit of 100,000, you are not deducting it from your total income, but you deduct it from your final total tax that you have calculated with corporation tax rates. So besides R&D credits, you also deduct patient box or double tax reliefs from the final total tax and not from your income's profits. So what this means? That means that some reliefs you reduce your tax bill, but not your profits. You are not deducting this from your profits, but you are doing this from your tax bills. So for example, R&D, research and deployment, or patient box, or these two, double tax relief or double tax relief. So you don't subtract them from income or profits. You subtract them from final corporation tax, your corporation tax. And for patient box and the double tax relief, this is the same idea. They reduce the tax payable but not the profits. So that was all about our second video of corporation tax. We have discussed all the calculation processes of the corporation tax, step 1, step 2, 3, and the last one, the fourth, when we were taxing, when we were ending up with total taxable total profit and calculating the corporation tax. So that was all for this video. Thank you and see you in the next episode.